Kia ora. Ngā mihi nui kia koutou, ko bariko saho, ko te kārahi o te patea whai whakara. Nau mai haere mai ki tēnei uienga. Welcome to this special interview we have today. I'm Barry Coates. I'm the CEO of the charity Mindful Money. And I'm very pleased to welcome our guest here today, is Brian Henry. He's the founder and director of an organisation called Always Ethical. They have products of Always Ethical Investment Fund and AE KiwiSaver. And we're going to talk about their investment approach, their ethical approach, their results, and a little bit about the organisation itself. So without further ado, Brian, can you just tell us a little bit about yourself and Always Ethical and a warm welcome to you.
Yeah, first of all, Barry, I'd like to thank Mindful Money for what you're doing. As you'll find out through this discussion, what we originally set out to do is now actually modified as a consequence of Mindful Money, and we think it's a very good service, and we hope investors keep looking at your website because it does give a very important part of an investor's conscience in doing KiwiSavers and the like. We started Always Ethical as the first of the ethical funds. Everybody suddenly found that was a great buzzword, so they run around and use it. But at the end of the day, ethics is a very serious thing. So when we first set up the fund, we decided that we would write a written ethical mandate we're going to stick by. And that's a big difference between us and other funds. They all say, no this, no this, no that, but we have a spelt out mandate. One of the big things with us is the level of debt in companies. We do not invest in interest products. We don't invest in gambling. That doesn't mean casinos. That means a product that instead of making or doing something, actually gets its result by chance. And there's a lot of products out there people don't realise. Derivatives are pure chance, and they're not actually backed by people doing or making something for the good of humanity. And that's our catch cry. Everything should be for the good of humanity. So we differ from a lot of the, what I'll call the sort of standard fund jargon. They terms like ESG. We do not follow ESG. We look at it. But governance is governance, and governance is good governance, and I don't care race, creed or colour who's doing governance. I want good people managing the companies we invest in. The other thing is no company is allowed to have more than 30% debt on its balance sheet. And that's very important because once a company goes past 30%, it's starting to increase its risk. A company with less than 30% on its balance sheet is not going to go broke unless something extraordinary happens. So we play very much into safe, solid companies doing or making something for humanity, and humanity is our catch cry. That's the biggest difference between us and our competitors because all KiwiSavers are the same except for where and how they invest and what ethos they have in their investments. And to us, ethical investing is important. And Mindful Money with the ethic markings you do is a very useful reference for investors. But we're not into the activism investing. We don't go out actively to change the world. We just go to live inside the world who's already being ethical.
During the podcast, we'll come back to a number of these important issues. One of the things that's always appeared to me to be quite distinctive is that you have an investment approach which is quite clearly defined and quite strict and frankly quite different to many other investment funds available to investors in New Zealand. Can you talk about the approach generally?
Yeah, the general approach is at the moment we invest into US listed stock because of the liquidity. We are looking at some real estate in New Zealand, but that's something to come. And the biggest thing is we actually select our own book. So we work out what stock we like, and that book can be up to 50 stock. We don't play the stock. We don't play the market with the stock. we actually balance the book against risk in the market. So we will hold cash against equities, and by doing that, we shift and move, and we just control the risk. So recently, we've just had a very active time in the market with Donald Trump coming along. The market dropped. A lot of stocks were dropping 10, 15, 20%. We topped up some of those from the cash we're holding, but we were sitting basically 50-50 cash equities. We're now 93% equities, and we've just bought a whole lot of stock very cheap in the market. And we buy the book. We don't just pick one stock, that stock. We actually back up the book we've got. And it's not a case of, oh, this stock's doing good. It's what stock are in our book, and we just weight in that way.
Yep.
We did add 2 new stocks, and they've been very good new investments, but the basic book is the same consistently right throughout a long-term period.
So that is quite a different approach, because most other fund managers have quite gradual changes in their asset allocations between different types of investments, so between equity and cash, for example. But actually, you will take make quite significant changes depending on your analysis of the level of risk that faces. Sometimes people in the finance world says, "Oh, you can't time the market," But in a way, you are taking those judgment calls.
You can time the risk of the market in a very wide sense. Day by day, no. Right. But in 2020, February, the investment committee saw that the market risk was going up. So rather than take that risk, we very conservatively moved to 25% equities, 75% cash. Now, that was a deliberate move, and we might have lost a bit of money in the market, but better than being in the book and losing a huge amount in the market. So it's you reducing the risk is a better way of putting it.
Yep.
Now, in February 2020, as we know, the market towards the end of February, early March, collapsed badly.
Yep, this is during the whole COVID crisis.
Yeah, that's right. So we bought back in, and that year, KiwiSaver made 24.9% growth, simply because we were managing the risk of the book.
I seem to remember the market average at that time was a loss of about 3%. So to make a positive 24% was quite remarkable.
But the only reason for that is that you watch the overall, where's the market going? And put it bluntly, Donald Trump was a market risk.
Yeah.
And we edged up to 50-50. And the reason for that is we had a couple of really good stock. Price drops 20% because the market's fickle. We put money on the nose. So we brought the total cost of those stocks down. And those stocks are doing well at the moment. But then he gets elected. You've got all this hysteria running in the market. And we just sat and watched. And when you saw a big significant move like in the last couple of weeks, we said, right, it's now a point where we're going into the market and we'll sit now for quite a while.
Yep.
It'll go up and down, but it is benefiting our investors. And that's the key.
Yep. And in a way, you benchmark yourself to the market average. And I guess it would be fair to say you've got a bit more volatility than some other investments, but when you do outperform, you seriously outperform.
Yeah, we have more volatility in a sense, but volatility is actually the opportunity. It's not, you're not going to lose the money. Yeah. You may for a week or two be down a bit, but the nature of volatility with stock that have only got 30% debtors, they're all coming back. And when they come back, you come back with a vengeance. So over a year, we don't have high volatility. Over a day, yes, we can.
Yeah.
But it's a case of we actually manage risk. That is our focus all the time. What is the risk to the book? Yep. And that's our number. And that's where we're totally different, is we think in risk every day of the week. And as I said, people like Donald Trump, impact on the market. And remember, stock markets are a herd. They're not a financial, smart, moving, consistent, principled thing. They are just ordinary people who panic and do all sorts of things. Professional brokers panic. They all do that. Our whole role is just to sit back and watch. And we're sitting in New Zealand, so we wake up in the morning and the American market's just finishing doing its darndest. 10 o'clock in the morning, you get all the announcements on the closing bell. We've got all day to think about it.
Yeah.
We instruct the broker, and come next day when the market opens, fine. The American stockbrokers, they are staying up late at night to make their decisions. We're wide awake. We've had a good sleep. They haven't. And that's a huge advantage. Being in New Zealand, managing an investment book in the United States stock markets is just a timing hoot. It's great.
Yeah. So, Brian, I wanted to come back to this issue of risk management because it's really important to you. And you've mentioned the kind of internal rules you have about not investing in companies that have high levels of debt, over 30%, or, that's even moderate levels, and also not wanting to fund speculation and gambling, etc. Can you talk more about that philosophy of investment? Because it's quite unique for your fund.
The biggest starting point, 30%, is incredibly low debt.
Yeah.
And we make no apology for that. So we take 22,000 stock and reduce it to about 500. So straight away you've got rid of an awful lot of investments you could do. But the thing is, you then say, right, what are the companies available that are doing something by doing or making something for the good of humanity? So you've got a cash flow. They have to be doing or making something. So your investment's underpinned on a cash flow. You can look at the market, you can see the products they're making and see what the market's saying. You can go anywhere in the world to a shopping mall and you'll see the products of a lot of these companies. So you can actually get a feel of where they're going. And you don't need to listen to the reports by people in New York selling you all this information. You can actually look at and feel what our companies do. So that's your first position. The next thing is that the market, as I said, is a herd.
Yeah.
So we have a situation where we're looking at what the market's doing. So what are the trading volumes? Yeah, Apple, for example, in a night trades more than the whole New Zealand Stock Exchange in a year. So you're talking huge volume trading. And if you see trading levels starting to wean off, and I'm talking across the whole market, then you know something's starting to worry people. And we saw that trend a couple of weeks ago. People got so nervous over Donald Trump and what he was going to do, it just slowed.
Yeah.
Right. That tells you your risk's high, hold your cash.
Yep.
Unless you get one of your stocks that suddenly drops out and you know it's a good company and you're suddenly getting it 20% cheaper. So you buy it. And that's what we've steadily been doing. And we shifted from sort of bit more than 50% cash to a bit under 50% cash because, we put sort of 1.5 million, something like that, on the nose of a good stock like that. Yep. And you're spreading across 35, 40 stocks at the moment. So you're managing the risk and you're also bringing the cost of your stock down.
Yep.
So that's a huge advantage. Then all of a sudden you see these good stock doing something still. Some of them got slowdowns in the market because people aren't spending, that sort of thing. But in 5 years' time, they are going to be roaring. And we've got a 5-year horizon.
Yep.
So if I've got a good stock at the moment and we know in 5 years' time they're going to be back all fine, we don't mind buying them as long as we're reducing the total price of the book, increasing the number in the book. So that's really how we manage our risk. Yeah. And I believe that's different to everybody else.
And then you also kind of have an avoidance of financial risk, the kind of the derivatives, the finance companies, the speculators in the market.
Yeah.
So again, that's quite distinctive.
We don't touch companies that are based on earning interest.
Yeah.
And the reason for that, and this is another major difference, the reason for that is really sound. First thing is, a company, a bank, is not doing or making something for the good of humanity.
Yep.
They're just a leech riding on the backs of people. The other thing is we want to participate in our investments with the risk of the company we're with. With a bank, their idea of risk is selling up grandma's house if they don't get paid. We don't find that a pretty ethical position to be in. if you're going to lend money to or back a business, have the balls to stand up and take the risk with the company. And that's what we like to do. And, they're very low debt, but the key is what they're doing is for the good of humanity, and that's a pretty good place to start.
Yep.
And that's what we do.
So let's come on to that good for humanity, because again, that's distinctive. So, as you said, Mindful Money is a charity that promotes ethical investment. We've got designation for those funds that we call mindful funds that meet strong ethical criteria. And I would say that Always Ethical is kind of right up there in terms of your strong ethical standards that you are very insistent, very disciplined in implementing your standards. So where did this come from? What's the derivation that brought you to the stage of saying, yes, we'll stand for these ethical principles, which, by the way, kind of most New Zealanders actually support, as shown in our annual surveys, but you're doing it and most other funds in New Zealand aren't. So
Okay.
what took you to that place?
I'm a barrister by trade, and there was a huge company collapse in the early 70s called JBL.
Yeah.
And as a young lawyer, I became involved in cleaning up that mess. I was involved in Security Bank, right through Equity Corp, you name them. I've been somewhere in every major liquidation in New Zealand since the 1970s. And the one thing you work out is these companies fail because of credit risk.
Yeah.
And that's borrowing money. And these companies, the finance companies in 2008 destroyed so many of my friends my age, assets that built up, and they totally destroyed it.
It was huge, wasn't it?
It's huge.
Yeah, absolutely massive.
I get really frustrated because the current law, risk in your PDSs is measured by volatility.
Yep. PDS has been the product disclosure statements.
Yeah, that's the mandatory document you put out.
Yep.
So you look at my fund and I'm high risk.
Yep.
I'm high return and I'm high risk. If you go to their formulas and you go to the low risk end, every finance company that failed in 2008 would be low risk. Why? Because the contract says you pay the interest.
Yeah.
But it doesn't take into account the fact that all of these companies were investing in real estate, speculation. All of them were second mortgages, but it's a mortgage security, and they had high interest being paid. Well, what happened? One day they couldn't pay the interest.
Yeah.
It failed because then they couldn't refinance the capital, and they lost everything. They lost the capital.
So many people lost their life savings. It was an absolutely crippling time. I remember it well.
But that's credit risk.
Yeah.
Nobody takes account of credit risk.
Yeah. Yeah.
But that's where people lose their money.
So you're getting assessed on the fact that you're high risk because you're invested in equities, but you're saying that the companies that you invest in are actually those companies that are sound and are a good risk. So that's the way you manage the risk at the company level, not at the investment level. But you do both. But
no more than 30% dent on the balance sheet.
Yeah.
They're checked every day.
Yep.
We get a report. They meet our mandate every day.
Yep.
We have an outside auditor who does a review at the end of each year and certifies that every day we have complied inside our mandate. Now, no other company does that.
Yeah.
First, because they don't have a mandate that we audit reviewed. But this is our actual financial auditors, totally independent. They come in and they do that review every year.
Yeah.
And we just document it every day.
Yeah.
But the thing is, we monitor compliance with the mandate, particularly compliance with that 30% rule.
Yep.
And that means our companies are not going broke.
Yep.
So risk is very small.
Yeah, it's important for people to understand because sometimes these published risk ratings don't actually tell them the reality. Right. So it's good for people to know.
Yeah, but you can pick up our pricing tomorrow.
Yep.
Oh, my price has dropped.
Yep.
But in 45 years' time, that's irrelevant.
Yep.
In 45 years' time, we'll have grown and keep growing because good businesses doing and making something humanity wants and needs always will come through.
So let's turn to some of the other aspects of your ethical policy, because you also avoid investing in things like tobacco production and gambling and fossil fuels and so on. So what are some of those decisions related to, and do you think they help your level of financial return?
I think it does, simply because those aren't good for humanity. And pick on tobacco. We dropped out of tobacco. There was a fund before the current funds. And the reason for that is a thing called class actions.
Yeah.
So you watch like mad for class actions or causes of class actions in the United States, because a company causes problems, and we had one recently who misloaded their software, really upset the market. We were in it, we just sold out straight away.
Yeah.
So we just cleaned out, took the loss, and then you go ahead. But the whole thing is that we won't go back there because the stock's recovered, but the class actions are still coming.
Yeah.
And they will get taken for a lot of money because they caused a lot of damage.
Yeah.
And the class action in America is the trash collector that cleans up the garbage in the stock markets, and they are vicious.
Yeah. Yeah. And there are a lot of them going on in all sorts of sectors. A lot of pharmaceutical companies, for example, are being caught in class action suits for being negligent. And
we might see a few more coming out of what's going on in the States right now, because COVID looks like it's going to come back and sting a few people from what we're starting to see. And we're watching like hawks these disclosures coming out of the US aid fund.
Yeah. Because
some of the stuff we're starting to hear and see is worrying. Yeah. And it's going to worry the market.
And also the opioid crisis in the US and so on. So there's a lot of those kind of cases. There is a lot of evidence around to say that if you invest ethically, then generally you will earn returns that are as high, if not higher, than traditional investing that ignores ethical issues.
Yeah, we have to say as high or higher.
Yeah.
Personal view, higher. Yeah. Every time, because this is not a one-horse race for 2 days. This is, for KiwiSaver, for some people, it's a 45-year race.
Yeah.
And over 5 years, that sort of investing will always pay off.
Yeah.
And that's, to me, why we went to this wording of doing or making something for the good of humanity.
Yep.
And humanity is a far wider thing than ESG, environmental, social, governance is fine. I totally believe the governance is a nonsense. Good governance is good governance. Environmental and social, they tend to be a box here and a box there. Humanity is the whole thing combined. And you've got to look at it combined.
Holistically.
And you see the whole holistic picture of what a company's doing. And it's very important.
Yeah,
it's very important.
So if you're an investor, then you can have high ethical standards and good returns. The two aren't a trade-off. People who go and buy organic eggs or something say, "Oh, gee, those cost me a lot of money." But in the case of investment, actually, the two go hand in hand.
Yeah, we consistently run in the top 5 of KiwiSaver returns. Now, every KiwiSaver's going to have a variation. 1 week you get ahead, 1 week you get behind. At the moment, we've got some people investing in digital currencies, which I think are an absolute non-investment. It's worse than interest.
Speculation.
Yeah, it's worse than interest.
Yeah.
And if you've got a bar of gold, you've at least got a bar of gold. If you've got a digital coin and the value collapses out, you've got nothing. Gold is not a true investment. It's a bit of metal. Doesn't earn anything, doesn't do anything, but you can sell it.
Yep.
A piece of digital is only sellable so long as someone else's head thinks it's got value.
Yep.
Doesn't do anything good for humanity.
Yeah.
It's straight speculation.
Yeah. So tell us more about your investors. So people find out about you. Where do people come from who come and invest in you? Kind of, I guess you have a particular clientele who know who you are, who've heard of you. Yeah. But how do they find out? How do they come to be attracted to Always Ethical?
We just clicked over 100 million on the 6th of January, so we're pretty proud of that.
So
getting bigger.
Yeah.
But the thing is, it's come from religious communities.
Yeah.
It comes from people in the green type role of life. We've had a few vegans who like us because we don't have any meat investments at the moment. We can invest in meat, but we do have prohibitions around the types of meat we invest in, which really takes out all meat investments. That's the reality of it, because any listed company that's a meat company will deal in every type of meat, and they're just gone because we just don't want to have the problem watching them and controlling them. So really we are in sort of farming areas, pharmaceutical areas, all the things that make the world tick and go along.
Yeah.
And that's just the way the mandate works.
Yeah. We've noticed from Mindful Money that a lot of people are finding you through seeing your strong ethical stance and your good returns. And so as a, I think it's been great to see a lot of people finding their way to you through our website.
Well, I've got to admit, we actually crib your stuff in the investment committee now.
Yeah, that's what it's there for.
It's become something we look at. It doesn't control and manage us, but it's another source of good intelligence. Yeah. And we're really grateful for the work you guys do. And it does give us that second reassurance to say, what we're doing is still within the bounds of being ethical. And I know we had one company that you had us on for a while, which did do some testing on animals, but only if there was no other alternative and it was for the good of human beings, medicines, and you kept knocking it for various reasons, plus we got rid of it.
Yeah.
And we made the conscious decision, we're going to look where you guys are. If we're going into an investment that doesn't come within what you're measuring, we're going to think long and hard before we touch it. For the simple reason, we've got an independent, different voice that says no. And we listen to that.
And the other thing is, before we go live with any of our companies on the website, our analysis of portfolios, we will come back to you and say, here's our analysis, tell us if you disagree, and we can have a conversation around the research. And
we've had good conversations.
No, it's good.
Haven't always agreed, but we've had good conversations.
Now, so tell us more about yourself, about Always Ethical as an organisation, kind of the people, the way you work. So, you're a leading, busy barrister who's involved in some very high-profile cases, and yet you have time to be director of this organisation.
Yeah, we've got a really good team.
Yep.
We've got 2 young ladies who have got very high qualifications administering the fund and administering the investments, and they're the backbone. And Sandra Clark, our boss, she's the CEO. She's got a real magic about making a team, and she certainly understands there's no I in team, and I won't say the rest of the quote, but she keeps everything on the real straight and narrow. Everybody loves coming to work. One thing I always tell people, if you don't want to come to work, just tell us and don't come.
Yep.
Because if you're not wanting to be there, we don't want you in the team. And the other rule is, if you make a mistake, tell us. It's the time between when you realise you made the mistake and you tell us, that reacts. If you'll tell me straight away, I'm not going to do anything. Because isn't that trust?
Yep.
That's the best trust you can get. Yep. And so we always encourage them, everybody makes mistakes. I make mistakes. If you say you don't make mistakes, you're lying. Everybody makes a mistake. But when you do, own it up, sort it, on you go. And that's how we work. And it's a very efficient group. We're well supported with our registry, which is Apello. They do a great job. And that's a big part of the backbone. Yep.
And your governance board is comprises of people who have expertise in the area?
Yeah, Gregory Fortain's the chairman. Gregory goes way back in insurance companies into South Africa, into New Zealand. He was the race relations conciliator for a while. But he's got a real, fatherly's the wrong word. His whole approach is, right, how is everybody? How are the people? You'll ask Sandra, because Sandra attends all the board meetings, what are the staff feeling? You got any problems with staff? What are they? And his board mandate, control, whatever you want to call it, comes from a very human starting position. And basically, the company does what the company does.
Yep.
There's an investment committee that does what the investment committee does. They have oversight of it, but it's only oversight. They don't actually get involved.
Yep.
If they see something that worries them, yes, they'll raise it. But see, they're getting the reports. They get to see the checks every day we do on the mandate. And they mainly concern themselves with where we're going to with marketing, check that everything's being kept inside the mandate.
Yep.
And board meetings are actually a lot of fun.
Yep. Good.
But Greg gives us a hard time over how are we looking? You're a fund for the good of humanity. How is your humanity doing? That's the sort of line we get. But it's very, very productive. And it's everybody loves it. It's good.
Good challenge to walk the talk.
Good challenge to walk the talk.
To do that.
Yep. Yep.
Hey, Brian. So paint us a picture. Where to next? What are you working on? What are your kind of aspirations? What's kind of coming up that you'd feel really good about for Always Ethical achieving?
For Always Ethical, it's keeping doing what we're doing. We need to grow the funds under management to sort of 150 million. And at that stage, we can then branch out and do a lot more in terms of things we'd like to do. One of the consequences of our no interest policy is if we're holding a lot of cash, some organisations have to pay you interest in the United States.
Yep.
So that interest comes and that all gets donated to charity. And Kids Can's done very well out of us. Kids Can's made, $500,000 in the last 12 months out of us.
Great.
And
well
that's going back and that's feeding kids, and we're very proud of that.
Terrific.
At the moment, we're heavily invested, so no money there. But the market changes and we'll shift back, and again, we'll be there. But basically, we just want to keep on doing what we're doing and keep the ethos in the team and keep people happy, because KiwiSaver is a long, long march. And you've just got to keep your head and keep doing what you do and doing it right, but keeping invigorated and enjoying what you do. And, the whole team loves the job. I love coming into work. It's great fun. I do other barristering work, which isn't quite as pleasant as being in the KiwiSaver.
No, you take on some tough cases.
Yeah, well, we won't mention Glorivale, but
no.
It's for me, it's a fun part of my life and my job. I get up in the morning and I check. I've done the market research by 9 o'clock in the morning, and with electronics you can just check up where it's going, and it's just so quick and easy these days. It's not funny. But remember, we're watching the herd. We're watching the risk. We're not getting too obsessed about an individual stock in the book. Some bad news. We'll go and look at it in depth, and then it goes to the actual investment team and the managers of investments, and if we don't like what's happening, we sell it straight away. We don't muck around.
Yep.
Any breach is sold that next trading day. It doesn't sit around the book. We don't think, you breach, you're sold.
Yep.
And it's just a straight, don't even think about it. Just do it and then sort the book out after that.
And you're in the market at the moment, but things change.
Things change.
You may well be taking a different judgment about what happens in the next year or so. So, Brian, if you ask New Zealanders about investment, so there are 3/4 of the country who say they want to invest ethically, and what they mean is they don't want to invest in things that don't align with their values. And when you ask the people what they don't want to invest in, it's actually many of the issues that Always Ethical excludes in your investment. So can you just talk a little bit more around the exclusions and maybe let's start off with some of the ones around some of the what used to be called sin stocks once upon a time.
There's a basic group of things we prohibit. So you start off with alcohol, tobacco, pornography, those sort of generally accepted, not moral, not smart, not good for humanity at all. So they're the sort of baseline when you start. But where we start going differently is gambling. Gambling to us is not a casino. Gambling to us is a product based on chance. And this goes back. They have to be doing or making something for the good of humanity. Chance doesn't do that. So you take a derivative, say orange juice, There's no orange juice involved. It's just two people betting on the price of orange juice.
Yeah.
And that's what a derivative is. People don't understand that. That is another consequence. We can't hedge currency.
Yep.
And that's another big thing we don't do because it's a derivative.
Yep.
So you've got those basic things, but we put on top of that this measure about earning interest.
Yep.
Nobody else does that. And the whole point is interest to us, and we've seen it through all the years. Bank lends money to a farmer, market turns against the farmer, debt's a little bit high, they sell him up, sell up all his guarantors, mum, dad, whatever, bankrupt them.
Yep.
We believe you participate in your investment, so that's why we don't touch interest. Interest-based organisations do not participate in the investments they make. So we are looking at a product that will invest in young New Zealand farmers. It will not be interest-based. It will be based on us participating in the venture and taking our profit and turnovers out of it, but guaranteeing that the farmer will always have enough money to feed his family.
Cool.
That's the nature of that product, but that's down the track to come. Probably not part of AE KiwiSaver, off the side of AE Ethical somewhere. But that's the demonstration of what we call participating. And it's a really hard discipline because it's so easy to say, oh, yeah, we'll just lend some money and away it goes.
Yep.
We are looking at moving into some real estate that will be tenanted, but again, we've got the rules. We will not have tobacco being sold in them. We will not have alcohol being sold in them. We will not have anything that is pornography and immoral involved in them. And that's the tenets. Yep. We won't let any of that inside it. So everybody can rest knowing we are always consistently taking those baseline band things out.
So when we ask the public what they want to avoid, they come up with a priority list, and that's what we use on the Mindful Money website. And generally, Always Ethical doesn't invest in those companies, and that's a product of your own kind of prohibition list or exclusions list. And I guess the issue around having such a list is also, how you implement it.
Yeah.
And you mentioned that you do your auditing and your board does their auditing
daily.
And it's done
We
daily.
check daily.
Yeah.
Everything's checked daily.
Can you talk about how important that is to you and why you do it? Because others would only do this, periodically, once every 3 months or something.
If you're going to say you're an ethical fund, you've got to be an ethical fund for 365 or 366 days of the year. It is so easy to say, 31st March is coming up, let's get out of all these investments and, look, we're ethical.
Yep.
But that's not being ethical. That's deceiving your market. So we have this strict policy. You breach our mandate, we sell you the next day. We don't wait. We simply sell because we're breaching faith.
Yep.
The faith we have to all our investors is we will always be, and we call it strictly ethical, we will always be strictly ethical. And that means second you know you've got a problem, you sell it. Yep. And that's what we do.
So that's reassuring for investors who hear a lot about ethical, but a fair bit of it out there is greenwashing. And what you're saying is in order to implement it, you have to have some strictness.
And by the way, we ticked all your boxes from the day we started before you set them up. So those boxes you've got are the basic, solid, don't do's if you're ethical.
Yep.
And they're easy. All of that was bought with me because, as I said, I've seen the reason for failures since the early 70s in every company in New Zealand that's failed. And man, we've seen it all.
Yep.
We've seen it all. We've seen the immorality. We've seen the who cares about the investor. My job is to make investors money, but more importantly, to make it in a way, in a method that I've in good faith said I'm going to do, so they can sit back and say, actually, my fund is performing as well as them all. Sometimes we're first, sometimes we're third, sometimes we're fourth and a quarter, but we're right up there.
Yep.
But our ethics is absolutely audit reviewed, controlled and managed, so anybody can look any day of the week and I can tell them straight, hand on heart, we are within our mandate.
We have a little catchphrase for that. It's kind of feel good about your investment.
Yeah.
earn good returns,
Yep.
and do good in the world.
Yep.
Yeah.
1, 2, 3.
1, 2, 3.
But that's what we do.
Yeah.
And that was, I can remember when we applied to get our KiwiSaver license, it was quite funny. We went down to Wellington, and the actuary who was looking at it, he sat looking at our stuff for about 20 minutes, didn't say a word. And 20 minutes of silence, I tell you, is a very, very long time. Then he leads forward and says, "Oh, you're just an ethical fund." That's where we got ethical from.
Thank you. Yeah,
Simple as that. Boom.
Yeah.
Great name. So away we went.
Great.
But that's how we got it. Thank you, FMA.
So Always Ethical does a good job of making sure that you implement your mandate, and that requires, for example, daily checking on your ethical mandate and a lot of other processes. So in order to do so, you obviously charge fees as a fund manager. Can you talk about the issue of fees and how that works out for you guys?
Fees to a lot of people is very important. I consider performance after fees and after tax is the most important figure to look at. And as far as we go with the way we are structured, we are very good in performance and we're very good in minimising tax. So we've got a very good, robust structure we work under. I get very angry when you get people saying, "Oh, low fees, low fees, low fees." How you achieve low fees is you go to America and you get one of these big companies to invest in. So you put it into this fund, that fund, whatever fund. The issues, if you really research those funds as to what's going on with their ethics and their morality, is what you call opaque. You often don't know where the money is. I know where every dollar in my fund is invested, every cent. You can't audit those big guys. You do not know properly what fees they're actually making. You do not know how their books are working. But one thing I do know is that they cannot do what we do, which is hand and heart tell people, this is where we are. You can see every stock we're invested in. We don't tell you the ratios, but we tell you the stock. So you can go and check it for yourself. You check it on us every quarter.
Yep.
And that's what transparency is about.
Yeah.
And the whole thing is, those big funds are not transparent. But you can reduce your fees by simply blindly handing them the money and letting them run it. And they take whatever they take out of it. So when they disclose the fees, I don't believe anybody knows exactly what those companies are making. And the comparison's unfair to me.
So generally the low fees option is if you invest in one of these kind of big index funds and you just
That's right.
just invest a list of companies, no matter what they do, no matter how ethical they are. It's just a list of companies that reflects
You don't often know the list of companies, you just know the fund name.
Yep.
And to me, there's an opacity there I don't like. Now, some of our competitors probably do a pretty good job around, not criticising them all, but the concept of abrogating your responsibility of an ethical fund to an American fund manager, excuse me. We talked about Trump. Trump's a reality there. I don't have to like him or dislike him. I have to look after my people's money through what he does. Same with Biden. We had to look after their money through Biden. Doesn't matter what you like or dislike. Our job is to try and interpret what's going on, keep our ethical mandate, and keep getting good returns for our people. And one of the benefits for us is that we're not Americans. I've been to America, I've met American fund managers, and they're either Democrat or Republican. And the advice they give you is based on if they're a Democrat or a Republican. And they
tribal.
deny it.
Very tribal.
They deny it. Then the first thing you do is you mention the name like Donald Trump, and you find out which side they're on. They're all partisan. And we aren't. But the advantage we've got is we see those stock market announcements at 10 o'clock in the morning, and we've got all day to think about it, make a decision, send the instructions to the brokers if we're going to do anything. And we have huge advantages over them. But simply, I don't trust big American fund managers to manage my people's money ethically. The other aspect of fees for our fund is that we do everything here in New Zealand. All the stock management's done here. All of the research is done here. Every aspect of our fund is based in New Zealand. We're a specialist KiwiSaver. That's all we do. We don't do mortgages and other products like that. Our overheads are the same as any of the big companies. We do the same work, and at the end of the day, you've got to recover those sort of costs to go forward. Now, I'll give you an example. We don't call ourselves a vegan fund, but we watch where we're invested, for example, to make sure we're not in any meats we shouldn't be in. The reality is we are a vegan fund. We don't publish it like that, but that's what we do. But that's our team working through the day, researching, seeing what we're doing. Yes, we crimp off mindful money. That's recent, but it's an assurance. No, but it's an absolute assurance. And if we get into meat anywhere, the first place you look is going to pimp on us is Barry and the fund. Of course you are. You're going to come and say, hey, these guys are there in meat. We know that. We have thought about saying we're vegan, but it's too hard to guarantee to our standards that we are absolutely vegan. We do our best, but I honestly can't say we've got a prohibition, we don't have any meat anywhere. It just can't be done with the modern analysis available on companies that are listed in the States. But we're as close as can be. And at the moment, there is no intention to get into any farming with meat, people that chop up meat. But, for example, if you invest in some of the big stores, they do sell meat. But you can't stop that because that's a big part of a lot of those businesses. But we're none of those stores at the moment. The overhead cost is no different to the overhead cost of a big fund when it comes to the crunch, particularly around the investment side of what we do. Yes, administering hardships and all that requires bigger and bigger teams as you get bigger, but we look after all our people on that. We have an active policy on hardship. When we get someone come and say, we think we need hardship help, we actively get out, we get people involved to help them budget. They don't need a financial advisor. This is a mom and pop industry. They need help from someone who can do a budget for them, work out where their life's gone wrong, work out what they can do. But that's something we actively do. And these things cost.
Yep.
Simple as that. They all cost money. So, I get angry over this low fees mantra because we're not low service. We're high service. And we're high hands-on management of our investments. And to me, low fees means low service because you're giving it to the Americans, and I think that's horrific. The biggest ethos of the fund, and this comes back to what we say, that we work for the good of humanity as human beings. And at the end of the day, we're all human beings, and we believe our investors want to look after human beings. So that's our mandate, that's where we sit. When it comes to working in the investment market we've got within our mandate, we cut down 22,000 shares to about 500 shares. And these are very low debt, high quality companies doing and making something for the good of humanity. We've found that we're able to match, often better, our competitors who've got the full 22,000 shares to look at. That's achieved, from the mandate, because at the end of the day, good for humanity actually is good investing, but also because of the way we manage risk. And that's done completely in-house, and we've proven the formula we've got to be very, very effective. But it takes a lot of work, it takes a lot of time, and maintaining that audit level on all of our investments is a key, both to our success, but it's also an overhead.
We should leave it there for the audience and just say thank you so much, Brian, for your leadership of Always Ethical and for the interview today. And people can go to your website and have a look at Always Ethical. have a look on Mindful Money at Always Ethical.
No, we say go look at Mindful Money first because you'll see we beat everybody else. So.
It is good to have a comparative and objective view.
Well, I think
things.
it is. I think investors should get better information than what a PDS gives you.
Yep.
And your sort of service, I think, is very important going forward.
Yep.
So thank you guys as well. We appreciate it.